team. Welcome to episode 132 of Transition Talk, where we talk about dental transitions and how to navigate the sometimes messy path to practice ownership. While traditional financing is usually what's used in practice acquisition, seller financing can be used to help pay for the purchase. But how does it work, and how can it help or hurt you in your dental transition? In this episode, we'll walk you through the common scenarios where seller financing may be necessary, misconceptions about it, and how to determine if seller financing might be the right route for your transition. Hello, Mr. Loretto.
How does it, after 132 episodes, we still have new content?
I know. And this actually came from our team who said, hey, you have nothing on this topic. And we're like, how is that possible?
They even prepped this thing for us.
I know.
They're so good. You know, Christy, there's going to be a day that they run the podcast.
I can't. Actually, I like this, but I mean, that would be nice.
It's a backup plan.
It's a backup plan.
It's a backup plan.
We need some co-hosts.
Yeah.
Some additional co-hosts.
How's your summer? What's going on? You got to be busyness with kids and camps and...
I mean, I was talking to a girlfriend about it this weekend, and I was like, my mom just said, hey, do whatever, go to grandma's. There was no coordination of camps.
Oh, no.
There was no midday pickups, and can I take me to Chick-fil-A? And none of that. It is what it is now, I'm not going to keep griping about it, but summers are way busier. I did not understand summers when my kids were in daycare because all the other moms that had older kids were like, oh my gosh, it's summer. I'm like, my life is exactly the same, but it's not exactly the same now. And Lila is going to be 15 in September, which is crazy. So she is aged out of all the camps. So now I have to do something to keep her busy.
Yes.
That is not just laying around the house sleeping till 12:30. So it's an added layer of mom game that I've got to do.
I mean, we slept till 12:30, so
I've never slept till 12:30.
Oh, God.
It's probably not shocking, but 12:30 is a lot. Now, I might have laid out by the pool and watched some Young and the Restless, but never slept till 12:30.
I would never admit that I watched any type of daytime show. I could never admit now. I've done it, but I can't admit to it.
Oh,
okay?
Well, now we know. now you've admitted. What about you?
We've got a little summer getaway that we're doing. It's just a lake. I mean, right now I've got kids that are in master's programs. We've got Bryce is working at Grant Thornton this summer. Cole's in his master program. We've got Braden working. Bella's in summer school. So it's hard. You can't try to get these 4 kids and their significant others just to hey, we want to spend some time with you. We're about ready to drop tens of thousands of dollars on vacations for all of you. And they can't accommodate my schedule.
Yeah.
My flexible summer schedule, because I'm flexible in the summer. But no, they're all adulting.
They're adulting.
Yeah, I just bumped into somebody the other day, and they were like, I'm listening to the podcast. And it was 5 years ago, and it was a time that way early in the episodes where I had to ship Cole's passport up.
Oh, yeah.
And 2 young dental students were like, oh, man, we thought that was so funny. I was like, well, you're early in the podcast.
Yeah.
They've grown up.
Well, we have moved past.
Yes.
Past that.
Yeah.
Well, this is a good topic. I mean,
Good,
I think
yeah.
that this is not something we love. Seller financing. How often do we think this actually happens?
I mean, it's a tool, and there's different types of seller financing. Obviously, we'll get a chance to get into, but the 100%, the seller does the whole thing. I mean, I don't know, maybe once a year, 1 in 50 transactions, maybe.
Yeah, I think that's definitely true. And if you count our valuations, it's 1 in 100, a year type thing.
Yeah.
So I mean, I think that when we see seller financing, and we'll kind of go through the whys and all the things we normally talk about here, but when you see seller financing, if a buyer calls us and says, we're talking about seller financing, my immediate thought is uneducated, which makes me feel bad, or there's a lending issue with you, buyer, or the practice is being valued too much, right? Because those are typically the reasons why seller financing is put out there. There's a lot of misconceptions about it. So I guess we should start with just when are some common scenarios when we see seller financing being put out there that it's a legitimate thing, right? That it is a real reason why someone may consider seller financing.
The first thing that jumps at me is just, it's a family relationship.
Yeah.
It's a mom and daughter or mom and son, or it's a family transaction. And basically the seller, in this case, the parent is like, hey, instead of getting that loan at 5 or 6%, I'd lend it to you at 3. So there's typically some, I would say, a family thing or very close and a very wealthy person that's selling the practice. Recently came across one that guy is giving the practice to the associate. We're actually going to be helping on that transition. And so that's an interesting dynamic there. But same thing we'll get into is you're still going to need some money in this kind of transaction. So we'll talk about working capital here in a second. But there's typically a reason that's involved here. It could be the cash is really tight on the practice, meaning that it's $1 million practice and it has a 75% overhead. The buyer wants to buy it. The bank's like, yeah, I don't like the deal. And so perhaps seller has to finance it to get it done. It could be a situation that maybe it's just being offered and the buyer doesn't know. It says, hey, this guy just mentioned this. Well, do you know the terms of the deal? No, we really hadn't talked about that. It could be perhaps the buyer doesn't have cash and the bank's like, I like the practice, but I don't like you. There's typically something unique about the transaction. Could be a partnership, could be some existing debt. And the bank is looking at the deal, the seller's looking at the deal, and the seller has, maybe they just refinanced or just did a big build out project, and now we're going to call the $1 million practice, but they spent $500,000, $600,000, $700,000 on maybe a build out to go from 4 chairs to 6 or 7, 8 chairs to bring this young person in. They took out a bank note, and we're going to call that transaction a few years ago when interest rates were like 3%. So there's still this massive amount of debt, but now you got this young person coming in. And that young person, the bank, they want to look at the deal, but they want to take out the loan originally at 3, but now the new terms are maybe at 5 or 6. And so now we got to get seller financing involved. So there's typically some, like you said, sometimes there's just a unique opportunity that's just perfect and right for the buyer because of a family member or some just very generous person. But there's usually some type of, I would call it a problem or hurdle that we have to utilize this kind of tool.
Yeah. And I think sometimes when I mentioned earlier, when I hear it at the uneducated part, a lot of times the thought is, I want the seller to finance this so they have like skin in the game.
Yes.
Right. And like we
So
hear
true.
that a lot. And I think that to me, and we're going to talk about other misconceptions later, but I want to talk about this one now because when you say that, like that actually doesn't, like it actually adds a lot of competition. Yes. Do they actually now like you owe them money? Sure. But you know what that also means? It means they're probably going to be more involved in the practice. They're going to have more say. They're going to have more control. They're going to want to kind of be more involved. And oftentimes the terms aren't good. They're not what a bank can offer. I mean, it's an individual person. So I think that understanding the lending environment, I know we have a lot of podcasts on that. And again, educating yourself right now, if you are a buyer or a seller, on what the current market is. Like whenever you're listening to this episode, if those episodes are out, older, call us. We'll happy to connect you with like a bank who can kind of just talk you through like, what does it look like right now? What terms are being offered? What interest rate? Like, no, you don't have to put anything down. No, we don't care about student loan debt, because I think sometimes seller financing is just, people go to that because they just hear the general lending conversation about how interest rates are high on mortgages. And it's just a very different dynamic of lending, right? So like, I think that uneducated just means they haven't done enough digging to understand what this would look like from a traditional financing perspective. I would also add, in addition to the cash flow situation, I think you may have mentioned this, but just to reiterate, sometimes it's either the practice has poor cash flows or the practice has good cash flows, but the practice price, like in an ortho situation, is way above market. And so a bank still has their limitations. And so a seller has to partially seller finance for what above the bank can't do, right? So like understanding why it's being proposed, and then also depending on what side of the table you're sitting on, right? Like if you're a buyer whose seller financing is being proposed by the seller, okay, why? Why is that? Okay, oh, you just had a loan that was in 2021, and so you've got this great rate and you don't want to refinance. Okay, what are my options? I can go to your bank that you had that loan with and get a loan through them, but maybe then the terms are bad. Or I can go to you and you're willing to offer me something more market. If the buyer is proposing seller financing and you're a seller listening, why? Right? Like, did they have a bad situation with like a foreclosure and, the housing crisis, like whatever it might have been, right? We just have to understand the whys and then figure out, is that the only solution or is that the only solution you know about right now, right? Because there's a lot of different ways to like cross these hurdles.
One thing I'm going to comment there is go back to the $1 million practice, and it's a $800,000 price tag. You're right. In the buyer's mind, this whole like seller financing is just like very attractive in their mind. And let's say the interest rate, the bank is offering at 5 and they're willing to match it. I'd much rather just go to the bank at the 5%. I'd rather get my money, get my working capital and take the doctor that loan out, not be dealing with 6 months, 6 years. Hey, you're going to just making sure you're going to get my payment next week. I'm telling you, you just don't want to be dealing with this.
There's so much like messy in a transition, like especially in the beginning, to like add the layer of seller financing, like, because here I always kind of have to like reframe this when this happens, because sometimes the seller will say, I really want to seller finance because I want to get my money over time. We'll talk about that in a second. But then they act like it's a gift. Right? Like, but I'm financing you. Like, I'm giving you this money. Like, no, they are paying interest. It is a loan. It is a separate business transaction. This is not a gift. Like, they are still paying you for this practice and they own 100% of it, just like if they were to go to a bank. So we can't just say, because I am choosing to be your bank, that I am giving you this practice. They are paying you just like they would pay a bank. So just kind of reframing that it's not attached to the practice transition is just very, very hard.
Well, look, am I saying that we'll never do these? No. The same $1 million transaction, 800 price, the bank is quoting 5.5%. And the seller loves you, wants to do it for 3%, we're doing 3%. I'm good. Like 2%, 2.5% on $800,000 loan, I'm going to save $17,000, $18,000 a year. Sign me up.
Yeah.
Okay, I'm good. I'll deal with this little chaos, and you can remind me every week and month that I'm technically still over you, whatever, because it's a lot of money.
Yeah.
But those similar terms, I'd rather just move on, just knock it out with a bank loan.
Yeah. And I think how often do people want to do seller financing? I mean, that has changed. I feel like we're hearing it more in relationship to complicated lending situations.
Correct.
And less related to just like the desire to do it. In my opinion, because of post-COVID, money was super cheap, practices expanded, people acquired other practices, patient chart sales, all these things happened. So now practices are growing. They want to add different owners, like in the partnership situation, and they just have a lot, they're leveraged. They have a lot of debt. They have no desire to go refinance from the super cheap to the super high, but they want you to come in. And the rates now that the person can get are 8 at this non-acquisition bank that they use for real estate. And so the seller's like, okay, well, then I guess I'll finance it at 6, and that's still a win for me. So I think that it's just a complicated lending is what we're seeing more, which is why it's being thrown on the table. We're doing one right now. The seller was like, I'm happy to do it. It'll get us to a quick close. And you have a lot of flexibility in how you write those notes, which we can talk about here. I want to finish the other topic, but there are a lot of flexibility you can write in building out that seller's note so that both of you are protected. So we can talk about that. Let's talk about partial. It was one of the things that we talked about. Tell me your experience with partial seller financing. So this is when you can go out and get a loan for a portion, but then you have this other piece that you've got to kind of pay the seller that adds up to the total purchase price.
And the best example there is going back to your example, the ortho practices. We see these practices will typically be valued at a much higher rate. So let's say the $1 million practice at a GP level may only bring a value of $800,000. In this particular case, the orthodontist wants $1.1 million for their $1 million practice. So over 100% there. And the bank looks at the financials, production, collections, and basically says, hey, we will give you $900. That's the most we're going to give you. No working capital, just $900. But the reality is that we're still $100,000 to $150,000 short because we'll need some working capital on this transaction. And so now all of a sudden we need to get that to close. And so therefore we'll get that seller a kind of commitment to be a part of that finances. We're just using that piece that the primary banking is not able to do. And that's smart for the seller to get a transaction done like that, knowing that perhaps they're probably bringing a hurdle to this equation too. So they're maybe asking for a premium on that example on price. It could be the $1 million GP practice, but it didn't have a 55% overhead, had a 75% overhead. So the cash is tight. Bank's like, I get it, but we don't want to lend you this amount of money. We're not going to lend you 800, we're going to lend you 500, 600. But the buyer can still see something inside the practice, can still see the finish out and the equipment and perhaps the opportunity in the practice to grow and the lack of marketing. And, maybe the patients can be the fee schedule. So the buyer can see it. They're willing to do it, but then we're coming to us saying, hey, the bank's not doing it. What do I do? And that's where we're going back to that seller to say, hey, we've got a problem. If you can help us with this solution here. And at that point, the terms for the seller for the financing are going to be typically equal. And there are some times I've seen where they're actually greater than what the loan is back to the bank. The bank will sometimes say, hey, you need to match it because we don't want to have to try to rapidly pay down the seller. But in certain situations, it's a hurdle, but bottom line.
Yeah. And I would say that one of the things there is someone will say, oh, well, the bank's not willing to finance the full amount because we always say banks will finance 100% of your acquisition. They're not willing to give you the money, but they're still accounting for that loan in your cash flow, right? So they can still consider that 100% finance because they are actually taking what you're going to pay to the seller and building it into your cash flow, and it still has to work. They're just not willing to give you that extra because it goes above some kind of mark that they have. And you're right. I would say that we see terms typically have to be equal from a term. So if it's a 10-year term at the bank, it has to be a 10-year term with the seller. But they will say, okay, because the seller now doesn't have a lien, right? They have a second position, maybe their rate can be half a point higher. Or maybe you can also require them to refinance after 2 full years, or attempt to refinance, or you can start raising their rate, at a certain point. So every bank's going to have their own rules and every deal will probably have their own unique factors, but understanding as a seller, if you have to seller finance, you're going to have to be okay mimicking the bank's terms. You can't ask for a 2-year note, because bank is building in the cash flows to say, does this work for the buyer with your loan plus my loan plus their personal needs?
And this is typically a small amount. Okay.
Yeah.
So I'm going to, again, go back to the $1 million example. 800 is the price. The bank is going to do 700. We're only talking about $100,000 here. So your practice, instead of getting the 800 number, is going to get a 700. So it's a small amount. You've gotten 700 out of the deal. And so you're going to hold that as a seller for this period of time. And like you said, you can actually put clauses in the agreement that after a couple of years, we can come back and review this. And now the practice, instead of doing $1 million, is now doing 1.3, 1.4. The bank will actually come back and then take you, the seller, out and refinance it and basically pay off that loan to you, the seller. And you want that as a buyer. You want to, again, this was a hurdle. We had to try to figure this out. Your commitment is to maybe to grow, make your payments on time, keep the senior doctor happy, to hopefully be able to come back and help after the close with patients and hygiene checks and maybe even some procedures. But that relationship to let them know kind of what's happening in the practice so eventually you can pay them off.
Yep. And I think from a, is it the best option is a very lengthy answer. And you probably heard us already talk about some of those things. But I think that if a seller is offering full seller financing, oftentimes they're willing to do that, but they're willing to do it for 5 years or 6 years, right? And so understanding if you're a seller offering seller financing or feeling like you want to do that because of maybe some tax benefits, you're worried about the big tax impact of getting all your money at one time, which we'll talk about. Understanding that if a buyer can go out and get a 10-year loan at 5% interest, even if they intend to pay it off in 5 to 7 years, what that allows them to do is ensure that they have the sufficient cash flow in their early years of ownership to make sure they can invest and cover their own personal finances. And so if you're only willing to offer 5 years or a balloon payment, you're not market. And that's not going to be attractive to a buyer, right? So if this is really important to you as a seller, understand what a buyer is going to get, give them exactly those terms, you know what I mean? Kind of mirror what a third party could give them. And that's the only way that you're going to be able to beat what a third party can do. If there's no issues with the deal or cash flow or any of the things we talked about, it's just what you want. Well, then you've got to be willing to offer what is market. And then let's talk about tax, because that's a big thing.
So before we talk about cash flow, that is such a huge point we just said. Sometimes it's attractive to you, the buyer, because the seller says, hey, I'll do it at 4.5%. But the payback period is 5 years versus 10 years. And so here's the math. Let's say it's a $900,000 practice. Let's say the purchase price is $700,000. The bank says, I'll stretch out your payments over 10 years at 5%. Well, what that's going to do is it's going to cause bank payments of about $85,000. So if this business does $900,000 and it nets $300,000, if you go to the traditional bank, you now have cash of about $215,000, $220,000. If you go now to the seller, who's going to do that over 60 months, half the period, all of a sudden your bank payments back to, in this case, the seller, are over $150,000 a year. And now all of a sudden you just bought this $900,000 practice with a 65% overhead. And after paying this bank payment, you're down to $150,000. So it sounded attractive because it was maybe a little bit lower interest rate, but you weren't looking at the actual cash flow and the projections. And so that now becomes the problem. You're cash tight. I need new patients. You're so cash tight, you don't have the money to invest back in marketing.
Yep.
I got some equipment I need. Now, because we did this deal with the seller, we didn't get enough working capital.
Yeah, good point.
The working capital we need to make those, to have for those first 30 to 60 days. So I just want to re-emphasize here that the seller financing can be attractive in a few situations, but I would say the bank actually gives you more flexibility by looking at everything and giving you the money that you need at very competitive pricing.
Yeah, and I think the working capital, we've touched on that, or we've said that several times, but that's an important component, because if you go to a third-party lender, it's $1 million practice, you're going to get $1.1 million, and that $100,000 you're going to get to be able to cover payroll or supplies or just life for the first month or two while you kind of build the practice up. If you seller finance, the seller's not just going to give you $100,000, right? Even if they gave you a loan for 1.1, you still don't have the cash right there.
Right.
And so you have to physically, personally have that money and have a cushion that you know you are going to deplete, which is never the position we want you to be in, right? We want you to keep that liquidity that you've built up. Or some buyers will keep the AR and then pay the seller back for the AR 6 months or 9 months from now, and they'll use that AR that's coming in. But again, that's assuming that the practice has a good AR, that it's going to be coming in. You know what I mean? So there's a lot of things here that you have to understand that cash flow component in the early months. Even the best of best practices, buyers have to be very wary of cash flow in those early months.
One more thing and we'll move on. Even for the buyer that's thinking right now, well, what if I have $75,000 of cash just sitting in my checking account? I get it. You're going to put that $75,000 of your money. You're now broke. Your business has some money. If the business struggles those first couple of months for whatever reason, now we've got a business struggle. You've got a bank payment that's going out, at 15 grand versus 7 grand a month, and you're out of cash at home. It's just, we don't need that stress.
Yeah.
We need cash in the bank at all times. It's extra. We're nervous that we start with a 100, now it's at 200. These are good rich people problems. Now we can deal with maybe trying to pay down some of that debt that didn't make sense because we've got 200,000 of cash in there. So
yeah, absolutely.
Do you think we drove the point home of working capital and cash? Okay.
Cash.
Okay, perfect.
Sellers often come to us and say, I want to do this because I don't want to get a large sum of money and have to pay all the taxes on it. And so I want to seller finance so I can like recognize smaller amounts of money over longer time. So kind of what's the thought here?
So at Cain Watters, we've done literally 1,000+ dental transitions in the last 40 years. And so there's two aspects from a seller's shoes. You're selling your life's work, and there's going to be a dollar amount associated with this. So if the $1 million practice is 800 and you're going to give me 800, Christy, what I need to do and have my financial planner run is what is the value of $800,000 today? Let's have a tax plan with it. Let's figure out what that number is post-tax. Most of the dollars that you do receive in a transaction like this are going to be set aside to capital gains. 85% of the deal is going to be at a very low tax rate, and then a smaller percentage is going to be ordinary income. You pay tax as a seller when you receive it. So you have to balance out the tax today. The 20% is not going to go away in the future. It's going to be today, it's going to be tomorrow. So that part's going to be the same. Your ordinary income may adjust if you have higher income years. But the key component of this is measuring your wealth. In other words, if I got 800 a day, and then what would that look like over the next 10 years? Managing the growth of those investments and managing the tax. There's an answer to that. There's a set of circumstances you got to put with risk and tax and figure out which one has the most money in 10 years. The other is playing the tax game and the tax game only, where we take this amount of money, the 800,000, and we divide it up over 120 months. And then every year, you're probably going to pay me somewhere around $80,000, $90,000 a year, maybe $100,000 a year. And then when I receive that over the next 10 years, I perhaps are going to be in this lower tax bracket. Therefore, maybe I have lowered my tax. The point of this exercise is you have to run the numbers out from a financial planning standpoint. Am I better off getting the money now, tax planning now, taking the money and invest it, or am I better off getting the money over a 10-year period and tax planning along the way as well? And from a wealth accumulation standpoint, the reason that Cain Watters and their clients don't do seller financing is for the reason of there's an outcome that's better when you financially plan with it versus stretching this out. We typically would say is we're not chasing a tax, we're chasing a wealth strategy.
Mm-hmm. Yeah, I think that's very, very true. And I think that that's something that we are not thinking about because we're just focused on, at least from a seller perspective, it's just like, oh my gosh, how much your tax is going to be? I'm going to lose how much of this, but like the long-term growth of that money is really what we're trying to be in for.
Exactly.
Yeah. I mean, I think that like we've touched on so many of these topics. And I think that ultimately there's no right or wrong answer about the seller financing piece. Like to me, we see a lot of people that maybe just have a relationship, like the associate's been in the practice for a long time. Like for whatever reason, they're very debt adverse. And the seller is like willing to do that. They've saved up some money. Like, so I don't want anyone to walk away from this episode thinking that we are anti-seller financing, but just, I think we're anti-seller financing for the wrong reasons, right? Like this is a solution for some people in some transactions if the cash flows make sense.
Yeah, one thing we didn't touch on at all is you could actually do a seller financing option that's like a deferred compensation. So in other words, we value the business and basically I'm seller financing you because I'm just allowing you to become the owner over time, over maybe a 10-year period. And so I'm adjusting your comp and up over this 10-year period. And that's another example of what a seller financing deal is. You took a value and then basically we divided up over the period, and then I'm going to reduce your compensation that way. I don't like that either from the seller standpoint for the same reason from a wealth accumulation standpoint, it's not efficient. And the other reason is from a tax perspective, you're picking up, when I do an income shift to you where you're lowered and bringing you up over time, I pay ordinary income, and in that example, probably 37% tax on that amount of money. So that's a really bad idea. So there's lots of different ways to kind of play this out. And I think that one of the things that we really enjoy doing is just that education of showing options 1, 2, and 3 and how to do a combination of this or that for your particular circumstance. And sometimes we may be left with only one option, and that could be seller financing. It could be one option where we have to do something that these down payments or something we take a lot of cash. There could be a lot of different hurdles that we got to get over, and we're just trying to figure this out. And the seller financing is just one of these tools to get a deal done.
Yeah, absolutely. And I think if you're a buyer listening to this, understanding kind of what that looks like for you, and if you're on board with seller financing, what would my third party option look like? Again, you still might choose it, but like just understanding and have that data in your brain to understand like, what am I giving up? What am I getting? And if from a seller's perspective, if I do this, what am I not able to do with my money? What am I losing? What am I gaining? And there's also that personal aspect, right? Like we've talked a lot about numbers and the terms and lending, but the relationship aspect is really important, right? Like if you have a good relationship and you both see this as a business transaction and we're paying each other and we're going to keep that separate from everything else, that's great. But again, like if we have a messy and maybe contentious relationship, we're doing a walkaway or something like that, and we are just like want to cut all ties, like this makes it much messier, right? This doesn't allow you to cut all the ties you probably need to cut. So clearly a lot to think about, a lot to understand, but financing is unfortunately, a beast in this game of practice transition that you have to play. So understanding all your options and being educated about them. So
excellent episode, Christy.
Doing what I can on this summer day.
Thanks to the team that set this up.
Yeah, no joke. Thanks to August and Morgan and Bridget and Brandy and our wise leader, Joellen. All right, team. She cringes every time I say that. All right, team. That's all we have for today. Thanks for joining us on episode 132 of Transition Talk. As always, make sure to share the transition love with those who may not know of us yet. And of course, subscribe wherever you listen to your podcast. Until next time.
See you guys.